So welcome to this video. In this video we are going to discuss about the December 2015 NPV problem. We'll be doing record A using a normal terms the NPV approach, evaluate whether purchasing the machine is financially acceptable. So we'll start. So we'll be working out the requirement. Requirement A, and we'll have the particulars. Okay, and particulars we'll be solving this question in terms of thousands. We'll leave some space for it, and we'll also have one column for working note. So whatever working note we do, we'll refer it here, and we'll go through the question. ECO is appraising the purchase of a new machine costing 1.5 million to replace an existing machine which is becoming out of date and which has no resale value. The forecast level of production and sales for the goods produced by the new machine, which has a maximum capacity of 4 lakh units per year, is as follows. So the sales volume and the production volume is as follows: 3 lakh 50, 3 lakh 80, 4 lakh, 4 lakh. The new machine will incur a fixed annual maintenance cost of 1 lakh 45,000 per year. The variable costs are expected to be 3 per unit, and selling price is expected to be 5.65 per unit. These costs and selling prices are estimates are in current terms, that is, they are not inflated and they are in real terms, and do not take account of general inflation, which is forecasted to be 4.7% per year. That means the cost. So what are the costs we have? We have fixed cost and we have variable cost. That's why he gives you the word these costs. Okay, both the costs and selling price have to be inflated at 4.7 per year. It is expected that the new machine will need replacing in 4 years' time due to advanced technology. Resale value of the new machine is expected to be 2 lakhs at that time in future value terms. So this is a number in future value. So we have to discount it. So there's no inflation or anything required with this value. So the resale price is 2 lakhs. The purchase price of the machine, of the new machine, is payable at the start of the year, of the first year of the 4-year life of the machine. Working capital investment is 1,50,000, will already exist at the start of the 4-year period. So working capital is already existing. We don't need to invest. Due to the operation of the existing machine, the investment in working capital is expected to increase in nominal terms in line with the general rate of inflation. So the general rate of inflation is again 4%. So working capital is going to increase at 4.7%. So that alone we have to keep investing. ECO pays corporation tax 1 year in arrears. So you should be adding one more year to our normal operations, and the tax rate is 27%, and can claim 25% reducing balance tax allowable depreciation on the purchase price of the new machine. So the company can get the tax benefit here. The company has a real after tax weighted average cost of 6%, which is not required. This number is not required. What we require is a nominal after tax weighted average cost of 11%. So this is what we require. Okay, so so this sum has several working notes. So we leave some sufficient space for the main problem, and we'll start doing the working notes also. So we'll start from the years. So the sum starts from the 0th year and it goes to up to 4 years. The 5th year is the tax arrear. So we'll find out what number we want here. So what we'll do, we'll start from the working notes. So working notes number 1. If you look at this problem, in order to do it much more shortly, what we can do is, first we can deduct the selling price and the variable cost. We'll get the contribution per unit that we can inflate for 4 years. Okay, we'll get inflated contribution per unit. With that, if we multiply the units, we'll get the total inflated contribution number. That number we can put it here. So what we want here is the inflated contribution. So that is what we want. So to do that, we have to start from the working note 1, which we can take it as inflated contribution. So we'll start from here. So we'll have the years like 1, we'll have the years as 1, 2, 3, 4 years. Okay, if you want, you can even have the 0th year. That won't be a problem. So we'll start. So we'll start with the contribution per unit. So contribution per unit. Okay, so how much does it come to? See, the contribution per unit is 5.65 is a dollar. 5.65 is per unit, and the variable cost is 3 per unit. So 2.65 is your contribution, and that is what is going to incur for all the 4 years. But this is like before the inflation. If we take the inflation, it's going to be like 1 for the 0th year. From there on, it's going to increase by how much? The previous year plus the previous year number into the inflation. The inflation is 4.7%. You can close the bracket now. So if you look at here, the last year number is taken for the first year also, plus an inflation is added. The inflation is the 4.7. So we'll work it out. So we got 1.047. That's the right number. With that, we can copy and we can paste it for the other years. So the numbers should increase like this. Okay, once it's increasing like that, it means that you are working out in a right manner. So now what we'll get is, we'll get contribution per unit after inflation. Okay, so we can multiply and we'll get the answer. So we got the inflated contribution per unit. Okay, so that's done. But this is a per unit number. What we want is not a per unit. We want inflated contribution, or better, in a better word, we can take it as inflated total contribution. That is what we want. So we'll take the units. The unit is 350 because we are working out the entire problem in terms of thousands. So it's 350, 380, 400, and again 400. So we'll multiply both these numbers, the contribution per unit into the units. We got the total contribution. So we have done our first working note. So we'll leave some space, and this is our first working note. And for first working note, we'll just copy it and we'll paste it in our, in exam. If you don't have this function, you have to copy each number, or better, you have to type each numbers, because if you copy, you will copy the formula also. You have to type each number, or you can also use cell referencing. Cell referencing works like this. Assume that you want this number here, you put an in equal and you get it, you will get the cell referencing. So if you want to cell reference other numbers, you can just pull and you can get the numbers. So whichever is easier, do it. But the problem with self referencing is, if you have done something wrong here, okay, then that gets applied here and it will only lead you to a lot of confusion. Better just type the numbers here and you'll get the answer. So we got the inflated total contribution. The next number is obviously fixed cost. So fixed cost, we'll do it as a second working note. So we'll copy the same numbers and we'll do it for fixed cost. So what we want is inflated fixed cost. It's working note number 2. So we don't want these numbers. We'll just have the fixed cost, fixed cost before inflation, and we'll have the inflation, and we'll have the fixed cost after inflation. So the fixed cost is always the same number. It's an annual fixed cost of 145. So it's going to be the same number for all the years, but inflation is going to change. So inflation is going to be the same 4.7%. So better we will take these same numbers and we can just paste it. So we got that, and we can just multiply. Okay, we don't want for the 0th year, we want for the first year. You can just multiply this fixed cost before inflation into the inflation number, and we got our answer. So we can just pull it, and we got the fixed cost after inflation numbers. We can copy them all and we can paste them here, and this is working note number 2. But these are negative numbers, so you can put a minus symbol. So that it's easier when you add them together. We'll view the profit before tax. So profit before tax is very simple. You add both the numbers. And to find out the next step, just tax at 27%. As tax is in 1 year arrear, you can take this number into negative 27%. So you get the number and you copy it for 2nd to the 5th year. So you got these numbers, but we have tax allowable depreciation. So we have tax allowable depreciation, so that we have to work it out, and we'll work it out as working note number 3. So 3 is tax allowable depreciation. So how do we work it out? We have to work it out through a table. So which will start from particulars, and we'll move on to the years. Years will be from 1, 2, 3 and 4. We'll have opening value, we'll have depreciation at, the depreciation is at 25%, so that is what is being mentioned here, at 25%, and we'll have the closing value. Okay, and the tax allowable depreciation, that is a benefit. So we'll start. So what is the value of the machine? The value of the machine is 1.5 million, but we are working out it's 1.5 million. Our sum entirely works in thousands, so our answer comes to 1500 is the machine value. So depreciation is calculated on this number. So depreciation is 25%, which is a negative number. So minus 0.25. So you got the value. So add both, you will get the closing value. The opening value of the second year is the closing value of the first year. So we take that. The depreciation calculation is the same, so you can just take that. Closing value calculation is same, you can take that also. So now this you copy it and you can paste it for the 3rd and 4th year. So you got all the numbers, but the problem is there is a resale value. The resale value is 2 lakhs, okay, or in our calculation it's just 200. So what happens is the balancing figure refers to the loss on sale of asset. So that loss on sale of an asset is a income for the company. Okay, so what you do, you first find out the balance. So it is, we have sold for 200 an asset worth which is 432. Thereby we only incur a loss. Okay, so that is how we have found it. We have incurred a loss. For this 432, we'll get a tax benefit. So how does tax benefit work? Tax benefit is in arrear and it is a percentage of 27% of tax. So you take the depreciation and you multiply by the tax percentage, which is a negative number, minus 0.27. Okay, you multiply. That should give you a positive number, because a minus into minus will give you a plus, and tax allowable depreciation is a positive number. So work out for 5 years. So from second year to the fifth year you will get the number. So this is the tax allowable depreciation. Just copy that and go to your table here and we can paste it. So this is working note number 3. So now we can easily find out the profit after depreciation or after tax. So that is a very simple sum. So sum of PBT, tax and tax allowable depreciation. So copy it and do it for 5 years. You got all the numbers. So next is the investment. So investment cost is 1500. So we'll take it as minus 1500. And there was a resale value. So resale value was, when you computed it, the resale value was 200. So the 200 is a cash inflow. Still we have working capital investment. So for that we have to work out another note, which is called as working note number 4. So we'll start from here. So working capital. So working capital, again, we can have these numbers so that it's quite easy to calculate. So we have all the years. Working capital, he says, there's an opening value and there's an inflation and there's a closing value. So we can take this off. It's an inflation. Okay. So inflation is at the general rate, which is 4.7%. So at the first year beginning or the 0th year, it is 150. We'll check it once. Yes, the working capital investment is 150, is already existing at the start of the 4-year period. Due to the operation of existing machine, the investment in working capital is expected to increase in nominal terms in line with the general rate of inflation. So this 150 is already existing. What we have to do is we have to only increase the investment. Okay, so if you also see that this 150 is at the start of the year. Okay, 150 is the working capital. With that, every year 4.7 is going to get added. So it is into, it's going to be into 4.7 percentage, which is going to get added. So if that gets added, you just have to sum it. So we got the total number here. This number is going to be the opening for the next year, is 157. Again the same inflation will be get added. The same inflation will get added. Okay, and the closing is also going to be the same. It's an addition of the two numbers. What we have to do is we have to just pull it up to the 4th year. 5th year will not come. Cash flow would be like this. The cash flow would be a negative cash flow, because if you see, this number is what has to be invested every year, but this is a cash outflow. So we'll multiply it by -1. So we get the cash outflow number. So these are the cash outflow numbers. We have to check whether the working capital is released or not. So we'll check. If you go to the first formula, first paragraph, it says It is expected that the new machine will need replacing in 4 years' time due to advances in technology. So the working capital is not going to be released because there's another machine that is going to be purchased. So this working capital will not be released. So there's only going to be investment in this working capital. So we can take this 1, 2, 3, 4 numbers and we can put it here. So we have got these numbers. So that's it. We can now find out the cash flow. So the cash flow will be the sum of the PAT, profit after tax, the investment, the resale value, and the working capital investment. All of them put together we have to add, and we got a number. So we'll do the same thing for all the 5 years. We got the full numbers. We now have to get the discount factor at 11%. 0th year discount factor is 1. The first year's discount factor is, take the previous year 1 divided by 1.11. So we have done it, and we have to just copy and paste it. So we have got all the numbers. So we can find out the DCF. So DCF will be like multiplication only. We get the NPV. So NPV will be the sum of all the discounted cash flow. So we have done a one mistake. The cash flow occurs on the 4th year, not on the 5th year. So this will give us the exact answer. So the answer comes to 1121. Okay. So what is our suggestion? Our suggestion is as the NPV is positive, we can select the project. Okay, so that's about it. We have finished the answer. So the only small error that we made was 200. We had it in the 5th year. Be careful because the year end of the project is the 4th year, not the 5th. The 5th is only for the tax computation purpose. If you want, you can highlight certain numbers. So we'll highlight the years and NPV and suggestions, working notes. You can highlight these, this, the loss on sale of plant, you can highlight that, and working capital and these things you can highlight. Okay, so it's look neat. So that's about this problem. We will meet in the next problem.